Good day, fellow investors. I enjoyed this interview with David Einhorn, and he said how Warren Buffett is underrated for his market timing qualities because he's usually going to cash just before a crash. Here is Einhorn.
Another question. Warren Buffett is now piling up cash. How do you interpret that?
Warren Buffett is underrated over a very long period of time as a market timer. I think there are a lot of people who've picked stocks really, really well for a long period of time, but what I think has distinguished him, and people do not give him credit, is in the not in the, hey, how is the market going to perform today? And I'm going to change my forecast 3 weeks from now and then change it again in 3 months. But in terms of very big picture, Warren Buffett has been a generational talent as a market timer. He managed to basically sit out the bear market in the early 1970s. He managed to get out of everything that was liquid before 1987. He did the same thing with the internet bubble. He's done the same thing in certain fixed income. When 2008 came along, he was the guy with all of the money to bail out all kinds of things and take advantage of the opportunities that came to people who had money when nobody else had any money, or very few people had money. And I think that being able to buy and those kinds of opportunities are the things that have separated him from many other peers or semi-peers. He really doesn't have any peers, but the reason why he's, besides living as long as he's lived into his 90s and functionally well, which is something we can all aspire to want to do, is his big picture market timing has been amazing. And you see him selling Apple and other things like this. Apple, we owned Apple. It's the most profitable investment in the history of Greenlight. We owned it for about 5 or 6 years. It generally traded around 9 times earnings. It was generally growing about 20% a year while we owned it. And now it's at like 40 times earnings and it's growing less than nominal GDP. And Warren Buffett is selling it because he's raising huge amounts of cash. What he's going to do with it, he probably doesn't know. But if there's a better opportunity set to buy things, he's going to have a lot of cash to buy when that opportunity set comes along. And based on his long-term history, I think this is something to pay attention to.
So if I don't get copyrighted, you have seen the video. If not, here is my summary. Warren Buffett is underrated as a market timer. He always has this long-term big picture and nailing it correctly. 1968, he closed his partnership. 1987, he sold everything that was liquid and then waited for 88 crash, bought Coke, perfect timing. Staying away from the dot-com bubble, waiting for opportunities that were already there in value in 2000. You'll see that in the cash asset allocation in a moment. 2005, correct, buying Burlington Northern. 2009. 2021, doing more buybacks, and now going all in cash, predicting again the next crash. Here you can see Berkshire cash pile now at a record high, was already high here, a little bit lower here, but you can see here before the financial crisis, higher levels, also before the dot-com exuberance or dot-com value opportunities also at higher levels, and before that low cash, minimizing cash. But perhaps the better chart here is to look at cash position to assets. And you can see here we are now at record highs. We have been close there before the financial crisis and then bottomed in 2010 when he was buying and providing liquidity to all those that were selling and were requiring liquidity in panic. Similarly, before the dot-com bubble, also a jump in cash to assets. The key thing is that Warren Buffett has been investing since 1942. That was a time where my grandfather was running away from German airplanes, and therefore it's very difficult to comprehend Buffett's perspective on markets. That's certainly longer than all of us. But let's hear how Buffett looks at things. From the 1999 conference call speaking about the 1969 complete liquidation.
Warren and Charlie, good morning.
Good morning.
My name is Morris Spence from Waterloo, Nebraska. Some 30 years ago, you disbanded your Buffett partnership, saying that you felt out of step with the market and you feared a permanent loss of capital. Given today's market and current valuations, if Berkshire Hathaway was a partnership of 100 partners instead of a corporation, would you consider disbanding it as you did 30 years ago? And if not, why not? And was that the right decision back then?
Well, if our activities were limited to marketable securities, and I had less than 100 partners, and we were operating with this kind of money, so that there was a real limitation on what we could do, I would simply tell the partners and let them make the decision. That would be easy enough. We're not in that position. We've got a number of wonderful businesses, and those businesses will grow in value, and in some cases very significantly in value. And it's not a feasible way. People have their own way if they decide that since we're unable to find things, that they'd rather go on to something else. They have their own way of getting out, and they can get out at certainly a premium to the amount of money they put into the business over the years. So if I were running a marketable securities portfolio now, and we're limited to that, I would explain very carefully to my partners how limited my ability to make money in this market would be, and then I would ask them to do whatever they wish to do. Some of them might want to pull out, and others might want to stay. In the 1969 period when I closed up, I had a somewhat similar situation in terms of finding things, and B, I really felt that the expectations of people had been so raised by the experience we'd had over the previous 13 years that it made me very uncomfortable, and I felt unable to dampen those expectations. And I really just I didn't find it comfortable to operate where my partners, even though they might nod their heads understandingly and say that, we really know why you aren't making any money while everybody else is. I didn't think I wanted to face the internal pressure that would come from that. I don't feel any such internal pressure in running Berkshire. Charlie?
Yeah, I think there are some similarities between 1969 and 70 and the present time, but I don't think that means that 1973-4 lies right ahead of us. We can't predict that. You can argue it worked out wonderfully for Warren to quit in 69 and then have 73-4 to come into with his powder dry. I don't think we're likely to be quite that fortunate again.
Yeah, it was a long time from 69 though to 73. I mean, it sounds easy looking back, but the Nifty 50, as you may remember, sort of hit their peak in 72. So although there was a sinking spell for a while in that 69-70 period, the market came back very strong. But that's part of the game. I mean, it stayed cheap a long time from the 73 period on, and you will find waves of optimism and pessimism, and they'll never be exactly like they were before, but they will come in some form or other. But that does not mean we're sitting around with a bunch of cash because we expect stocks to go down, though. We keep looking for things. We're looking for things right now. We're talking to people right now about things that where we could expend substantial sums of money, but it's much more difficult in this period.
So Buffett is selling when there are no opportunities to buy. Also, if what he owns is overvalued, he also sells. So is that market timing, or is that just difficulty on finding things? I think we can name it as we wish. However, those things go hand in hand. If things are overpriced, Buffett can find better investments. He sells. Consequently, the cash position, everything that's liquid gets into cash. He is waiting for opportunities. And as he said, he's not predicting market crashes. He's just managing for his portfolio for value. But usually over the last 80 years, that has been prescient in predicting crashes and knowing that sooner or later those better buying opportunities will arise. And he has been selling the expensive Apple at a free 6% earnings yield, going into bonds at a 4% earnings yield with no downside. But put things into perspective. He has been high in cash for the last 2 years actually, a little bit lower here, and now really big into cash. But will the crash come in 2026, 27, 28, 32? Does it matter to Buffett and Berkshire if you take the long-term perspective? No, he can wait. He is just focused on doing well, not doing well every year. So he can wait, he can be patient, and those are the key qualities that also make Buffett the greatest market timer, even if he's just looking for opportunities. That's what we are going to keep on doing. You can check some opportunities already here, maybe too small for Warren Buffett, but that's value investing. See how what fits you, and then start building a portfolio so that you can sleep well at night. Thanks for watching. I'll see you in the next video.